All right. Hi, everybody. Welcome to another online educational session sponsored by Marshall Reddick. My name is Patrick Prunty, and I'll be your host for mortgages, trust deeds, notes, and private lending. And as always, I'm always excited to be here with everybody. Appreciate your time. Look, I started my career with Marshall Reddick more than 20 years ago, and I've done it all. Rentals, flips, I've wholesaled, I've built new construction, and I launched this private lending program that we're going to be speaking about tonight nearly 15 years ago. Bottom line, I'm a very conservative investor. I'll always take safety over yield, and I love nothing more than collecting a check for doing absolutely nothing. And as an investor in our program, you looking at our program and trying to decide if this is something you'd like to do, this is exactly what you'll get. A passive 100% cash flow play. So as we dive in, I love crowd participation. We'll test the waters. I'm going to go ahead and launch a poll. So I'd appreciate your participation. We'll get a sentiment crowd from everybody in the crowd here. So as I launch this, have you done any mortgage investing before? Give everybody a few seconds, and I'll also be looking at questions periodically. So if you have them, feel free to type them in the chat box. And again, looking to understand in our crowd, I know we've got a lot of new people. We've got some existing clients on the call, trying to get a bead on the experience level of everybody. Give a couple more seconds there before we go ahead and close that poll and move on. Wow, it does look like we've got quite a bit of new people on the call. Okay, so we'll go ahead and close that poll. Certainly be more polls coming. I'm going to share the results. And hopefully you can see those now. We've got about 50% of the crowd has done some lending before, done some trust deeds, some mortgage investing. Not too many full-timers as suspected. I love the risky votes there, right? I hope to beat that down a little bit and to show you that it's actually one of the safer investments that one can make. And I love, of course, the 33% from the news. So thanks so much for sharing. I really appreciate that. We'll have about four more polls coming up that will, share a little bit more about what we're doing here at Marshall Reddick. So as we move on, the agenda in this session, right? We're going to be talking a little bit and hoping to educate you a little bit more on private lending. Certainly poll questions that I mentioned. We're going to be really thoroughly explaining our private financing operation. I'm going to introduce you to our mortgage marketplace. If you haven't found that already, that's really cool. It's like a multiple listing service, but it's for loans. I'm also going to dive into how to get involved, and that really revolves around building relationships and getting to know me, getting to know my team. I certainly am not a one-man band. None of this works without a really solid, well-experienced team. And then, of course, our track record, which is something that I'm extremely proud of and looking forward to sharing with you all. Also, we'll get some sentiment on interest rates. I think the Fed had their last meeting of the year today, and hopefully we'll have some times for questions there at the end. For all those new folks that are out there, just a quick house cleaning. This is what our office footprint looks like. Our lending team today, however, is housed 100% in the Newport Beach office with me here in Orange County. But this is where we have our own brick and mortar offices. And so everyone's aware, we don't just lend money, right? What we do is we're a real estate brokerage. We help people buy and sell homes, primary or investment. We're a property management firm, and we also do offer the private financing. So this session focus, however, so we're clear, is all about making money, lending money, and doing so in our private financing department, which I refer to as some of those buzzwords, which are mortgage, trust deed, and note investing. Let's define private money. And this is something common, right? It's in the banking and finance industry, and it refers to lending money to a company or to an individual by a private individual or organization. So traditionally, we're all clear that banks are the primary sources of financing, but primary or private money has non-traditional qualifying guidelines, and there is traditionally, therefore, less red tape. Now, the one thing missing from this definition is that it's for real estate, and when it comes to us, the private money that we lend is all secured, meaning that there is residential real estate as collateral for the loan. Again, bringing that element of safety to what we're doing here. Okay, let's get into another poll question. Get that launched for you. This one's going to be, what's the primary reason for a borrower to use private money? And there's a lot of misconception when it comes to this. And so I hope to kind of tamp down some of that, because a lot of people think that private money is for the subprime. And in fact, it's absolutely not that. I would suspect, though, that a lot of people will suspect that that's the case. And there's a number of reasons that private money is important. I'm going to dive into some of that throughout this session. I'll give a couple more seconds there, and I'm going to take a quick peek and see if we've got any questions so far from the crowd. Okay, we're going to go ahead and close the poll, and I'll share those results. So surprisingly, we've got some well-educated, maybe you've seen some of my presentations or some of my sessions like this before, but the majority of you, 67%, looking to speed and timing, and that is absolutely correct. So the private money that we lend is lent to sophisticated individuals, professionals in the business, in the investment real estate business. It has absolutely nothing to do with poor credit or low FICO scores. It has absolutely nothing to do with their cash or their down payment ability. And it has absolutely nothing to do with income employment. And I guess I shouldn't say nothing with income employment, because when it comes to employment, in some cases, conventional is off the table, or a traditional financing, due to self-employment versus the standard W-2. But at the end of the day, the number one reason that folks, at least that are borrowing from Marshall Reddick, they're coming to us for speed and for timing. And I'm sure for those that are listening in, you may have been through the conventional or bank mortgage process sometime recently, and you understand just how painful that process can be. And so again, going back to kind of the nature of our borrower, right? Our borrower is going to be that sophisticated individual, experienced professional that's very, very good at picking up off-market deals or finding sellers that are distressed. And one of the main things that they need is speed in closing transactions, right? So we offer kind of that common sense, that no red tape solution, while still making it very, very safe for the underlying lender, who could be you. I'll go ahead and hide that poll and we'll move on. So as I mentioned there, our private financing operation provides a very needed common sense service to the borrower. At the same time, provides that safe, high yield investment to the lender. And so many of us out there are searching for that middle ground, right? Certainly there's higher yielding investments out there, but for how much risk? And then certainly you have options in terms of bank CDs that are actually offering pretty high yields, but you'd like to get a little bit better than that, a pace better than inflation, right? But it's gotta be safe. And so I really think that you need to give private lending a try if you haven't already. So then when it comes to Marshall Reddick and like what our team does, right, at the end of the day, we're arranging the transaction, right? We're the broker, and we're doing so between and amongst all the parties. So that's not only lender and borrower, but that's all of the other third parties that are involved: escrow, title, homeowners insurance, potentially 1031 exchange, and so on. So let's kind of get deep into our private financing operation. And this will give you a good understanding about what we do. So all the loans we make are non-owner occupied. That's very key. We don't want to be lending to owner occupants who could become emotional and whose ability to pay the debt service is predicated on their employment. Also very important to understand is going to be first lien position. Do me a favor, whether you're going to lend money with us or somebody else, do it in first lien position. There's just no return high enough, in my opinion, to take on anything other than first as a second or a third and so on. And a lot of people are confused on maybe what a second or junior lien would be, think a HELOC, right? And many of you may have those secured against your primary. That's a home equity line of credit. That would be a junior lien that's subsequent or behind your first lien mortgage. In terms of loan to value, very key, right? We only make good loan to value loans, right? There always is an element of skin in the game from the borrower. When it comes to the asset, it's got to be ownable. At the end of the day, you got to ask yourself, if you're going to make a loan, right? If you're going to lend money to somebody else, am I okay owning that asset for the loan or the amount I'm lending against it? If the answer is yes, you feel great. And so as we kind of walk through this, you're going to find that we only publish or show loans that fit these general criteria about our guidelines. So you'll find also that we only lend to recurring, experienced, and professional borrowers. We don't lend to weekend warriors. We don't lend to first timers, right? That's a recipe for disaster. Then it comes to underwriting, and it's got to be internal, right? We don't outsource that. We have a very actively managed team of 10 here in Orange County, as I mentioned. Very, very conservative underwriting, very skilled. These are very much like appraisers, but we go a step further than the standard appraisal in a lot of scenarios. And then ultimately, to kind of quantify the size of the program, we manage today around $110 million. We're originating someplace between 30 and 60 loans per month. And we currently, for that 110 million that we're talking about, that represents nearly 600 loans in the pipeline, meaning there's 600 loans that are funded, that are borrowed by a borrower and have been lent out by a lender that we're managing. A lot of those loans are paying off every day, and we're funding new loans every day as well. So when it comes to some additional details here about our private financing operation, let's talk a little bit about the borrowers and the lenders. I mentioned they were real estate professionals, but what's the profile of our borrower? We work with a lot of flippers, right? We buy houses for cash. We all see those signs around town. We also work with a lot of small home builders, not Lennar, not D.R. Horton, but these are infill new construction. Folks that perhaps used to be flippers, and when the distressed inventory dried up, pivoted and moved into new construction. A lot of different scenarios there. We also have a specialty niche, which is non-recourse debt. And so those of you who are familiar with self-directed retirement accounts and perhaps have one or are interested in one and interested in buying real estate using a self-directed retirement account, to do so, if you're borrowing or using leverage, you need a non-recourse loan. And so we have a lot of clients doing that. And so again, that's one of our specialties is non-recourse debt lending to self-directed retirement accounts. Then moving on to the lender profile, remember that's you're in the seat of the lender and you're trying to decide, hey, do I want to add a private lending to my investment portfolio? And if I do I want to work with Marshall Reddick? And so the folks there in the profile of our lenders, these are just private capital partners. These are doctors, lawyers, these are school teachers, these are just your average folks, right? These aren't large institutions. You can operate in two capacities with us as a direct lender, or I would call it a trust deed investor, or you can opt for a pooled or aggregated approach, which would be our Marshall Reddick Mortgage Fund, our debt fund. And then a lot of folks that are doing this are using their self-directed retirement accounts. We talked about a little bit under the borrow section there, and certainly some people are using those to buy and own rental real estate or other types of investment real estate. But a lot of folks that I work with, a lot of our clients are using their self-directed retirement account to either be a direct lender or to invest and buy a position in our mortgage fund. So again, self-directed retirement accounts, another niche of ours. So you have two options to invest in our overall private lending program. So when I talked about before about, hey, we're managing about 110 million and we're originating 30 to 60 loans per month, and we have 595 loans, almost 600 loans out in our pipeline, that's an accumulation of these two options, right? So there's the direct lending. This is the more active option, right? This is you decide, you pick and fund the loan. This is more akin to owning stocks directly. So if you're more active and you want to own Amazon stock directly, then you probably like to pick the loan that you're going to fund. This is a one-to-one relationship. So it's one lender on one loan, right? If that loan amount is 150,000, you need all 150,000. No crowdfunding, no syndication, anything like that on the direct lending side. When it comes to the debt fund, Marshall Reddick Mortgage Fund, this is the more passive option. This is a scenario where you have a minimum investment that you can put in. You don't pick the loans, you relinquish the control of picking the loans to us. And what we do is we're the professionals managing this every single day. So you invest and we pick and fund. It's again, more passive. This would be akin to owning a Vanguard mutual fund, again, as compared to the direct lending, more active and owning stocks directly. Let's talk a little bit about the role of Marshall Reddick. And there are many roles, but these are the primary. So we'll start with attract, and it's all about building the relationship. For us, it's building the relationship with the borrower, right? Borrowers come to us regularly and we support their investment business, right? These are not people that are new to us. They're borrowing from us in some cases, 20, 30, 50 loans per month. We're also building that relationship with the capital partner. That's you, right? And the lenders don't just come to us and lend their money one time. They get to know us and they lend over and over and over again, right? Because the idea as an investor is that you want to keep your funds invested 100% of the time. And of course, we are the shop that has the deal flow, right? That 30 to 60 loans per month that we need to get funded. And that's steadily growing. And it has over the past, 10, 15 years that we've been running this program. As far as the processing, the underwriting, right, we come up and we've established our own guidelines. We're a portfolio lender. We're not selling our debt. We're not selling it to Fannie Mae. We're not selling it to third parties. I mean, periodically, the need arises to sell a loan, and certainly you can do that, but you want to be investing in these loans and collecting the interest as an investment. So you rely on us to come up with guidelines that are safe, that make sense, that are common sense. We structure the loans internally, and we always do that a very specific way. We do it so that it's, palatable for the borrower, right? They'll still say yes and take the loan, but at the same side, it's as safe as humanly possible for the capital partner. So again, that loan structure is very important. And then also we're issuing the approval. So any loan that you would see or be able to invest in on our platform would have 100% Marshall Reddick approval. That's through our internal underwriting team. Then as far as, arranging, brokering the transaction, again, I mentioned this, but we're working with the third parties. We handle everything. We're communicating to escrow, right? There's always a third party escrow. There's always title insurance. It's mandatory, right? There's always homeowners insurance, flood insurance, wind insurance, whatever type of insurance that the underlying collateral property calls for, given the nature of the loan, the investment, and the situation. Of course, we're preparing the documentation, right? So the promissory note, the trust deed or mortgage, the borrower's closing agreement. We handle all of this. And these are all of the things that any lending institution would have, all of those safeguards, all of those third-party resources that are needed. Then when it comes to the management and customer service, extremely important to us, right? We pick up the phone, we answer emails. If you need something, we're here for you. So that comes to monthly payments that you receive if you're a direct lender, or quarterly distributions from the fund if you're a capital partner. That comes to loan payoff in terms of the calculation of the loan payoff and verification that it's that it's been calculated correctly. The release on the back end, a lot of folks forget that if you're going to be a trustee or a mortgage investor, you have a secured lien against the property, right? That's affecting the title records. Well, at the end, when you get paid off, you've got to sign a release. So we prepare the release, we facilitate it being you getting it signed. And then ultimately we're here working with you and saying, do you want to redeploy your funds again now? Because again, as an investor, it's all about the highest average annual return with the lowest risk possible, right? And if you don't redeploy your funds after payoff, then you're going to hurt that average annual return. So again, a little bit about the role of Marshall Reddick in this situation, this private lending program that we're running. Okay, so let's talk a little bit about the types of loans that we originate, because we're very specific about what we do. We make a lot of different types. I break them down into these 4 buckets. The top 3 are our short-term loans, right? The 4th option that you see, the hold and rental, these are a little bit longer term. So when it comes to the renovate, these are improving an existing asset. This is a flip. Okay, so these are 6 to 12 month loan terms, 70 to 90% loan to value. Mind you, all of the loan to values I'm going to quote here are based on the current market value and the acquisition price. So there's always skin in the game, right? And we publish our guidelines right on our website. I encourage you to check those out if you're interested in getting into the nitty gritty. You can find those under the borrow tab and the loan programs. But the point is, as the capital partner, right, you always need borrower skin in the game. So while we, some people might think 90% loan to purchase is an aggressive loan to value, and I would agree with that to a certain extent, you don't have to take that loan. We certainly have lower LTV loans. But these are going to also be the higher yielding loans, and you're going to get 10 to 12, in some cases a 13% yield. We also do some bridge loans, right? Again, all first lien position. Don't think these are juniors, but these can be as short as 12 months, but can also be as long as 36 months. And the situation that's different here is that there's no intent to improve the existing property. Not necessarily that it doesn't need improvements and the borrower is not planning to improve it, but maybe they're just buying at such a good deal that they don't want to do or need to do the heavy lifting in terms of the renovation, and they're just going to sell that off or wholesale that off to the flipper who's going to actually do the heavy lifting, right? And that's just one scenario that can fit the bridge model. So these are going to be a little bit lower LTV, and as you're going to find, generally the lower the LTV, the lower the yield. Generally, the higher the LTV, the higher the yield. And again, we're setting the interest rates and the points and the fees that are translating into the yield, and we're always doing so with what the private market will bear. Yes, we're looking at what the Fed's doing. Yes, we're looking at what the conventional mortgage rate is, but those things don't necessarily connect with the private market. There's a ton of private capital out there, and it's all competing for yield. It's starving for yield. So while the government has the ability to raise rates in its effort to tamp down inflation, private lenders can't raise their rates and their fees the same way that the government does, right? Because there's somebody else that's out there that will do it for a little bit higher LTV and a little bit less interest. And what do we want to do? We want to attract the best of the best borrowers, not the worst of the worst borrowers that are going to translate into problematic loans for us as the capital partner. We also do, as I mentioned, new construction, right? So these would be literally dirt and then going vertical. I absolutely love new construction. It's one of the safer, in my opinion. Again, it's going to be short term. We're looking at 12 to potentially 18 months. We have 70 to 90 LTV, but everything's done in a reimbursement style. So what I mean by that is we don't just fund a $300,000 loan and give the borrower $300,000 against dirt. No way. We originate a $300,000 loan, and then the borrower's got to do work. And when they do work, then they get to reimburse the work they've done. Then they work on to the next phase and they get reimbursed in the next phase, and so on and so on. Also a pretty good yield here when it comes to new construction. As for the hold and the rental, a little bit longer term, in some cases up to a 30-year fixed. We don't do a lot of that, right? We just don't have the appetite for it. There's a lot of interest rate risk that's there, but a 24 to 60-month term is very favorable. You can see the loan to values are lower with still a pretty good yield. So as I mentioned, myself being a very conservative investor who will take safety over yield, I love 50% loan to value. And if I can make a loan at 50% loan to value and earn an 8 or better yield, I am all about that because I just sleep so well at night. No matter what the market does, up, down, sideways, you name it, it's not going down 50%. And so it's the borrower's equity that could potentially be at risk, but me as the lender or us as the lender, 50% loan to value is an excellent place to be. Now let's talk a little bit more about private money and pros and cons, and a lot of this will be educational and from the borrower's perspective perhaps, but that's really important for you as the lender or capital partner to understand. So we talked about that the number one reason folks use or borrowers use private money is speed, right? They're scooping up bargain properties, and we close a lot of our transactions very quickly within 7 to 10 days. And a lot of the conventional lenders out there, I mean, they can't even take your application in 7 to 10 days. Our underwriting guidelines, right? The deal, the borrower is getting the deal, right? How deep of a discount are they buying off current market value? How much spread is in the improvements and the after renovation value? What kind of down payment? What's their equity at risk look like? That's really what's important in private money when it comes to underwriting, income, FICO, employment. These things, not that they're not important, they're just much less important in private money. Remember, we're common sense solutions. We hedge our bet and our risk with low loan to value, right? And that is how we're able to make this happen with a very, very safe profile. Fees and rates, we talked about this briefly. Private market sets the standard based on risk, right? Not the government, not Fannie Mae, right? So just completely different than the conventional lending or conventional money that's out there. The loan terms, right? The difference and kind of some pros and cons. This being a con to private money, okay? Short duration, 6 to 12 months. There's prepayment penalties. There's balloon payments. These are things that you don't find, of course, in your traditional or conventional lending where the standard is at 30-year fixed. So these top two are the pros, or at least some of the pros, and the bottom two are going to be some of the cons to private money. Let's talk the difference too between like private lending and buying notes. Notes is kind of a buzzword that's out there, and we don't do a lot of that, but it's important to understand, you know, the difference here. So originating, which is what we do, which is private lending, this is funding a brand new loan for a borrower. The loan amount is non-negotiable. That's already been negotiated and agreed upon, and it's based on the appraisal and the current market value and so on. This is the primary market, not the secondary market. So loan terms are established in private lending at the origination. New loan docs are signed by the borrower. Versus the secondary market or buying notes, which is you would purchase the loan, an existing loan from the current lender, and you can negotiate the price you're willing to pay in the secondary market to buy a note from somebody else. Okay, this is again the secondary market. There's no change to the existing loan terms, and oftentimes the borrower doesn't even know that there was a loan sale here, right? They just keep making their monthly payments to the loan servicer. So the current loan and the current loan documents are simply assigned by the existing lender to the buying lender. Okay. So again, just to kind of quantify the difference between private lending and buying notes, primarily Marshall Reddick's operation is private lending, and we're originating new loans. We can, however, if there's a need, say a death in the family, family emergency, some type of reason, if you need to sell your loan that you originated with, we can help you do that. We can certainly add a lot of value there compared to note buyers that are out there trying to get you for cents on the dollar when they know you need to sell. Again, just some education there. Okay, so Let's introduce our mortgage marketplace. Now we've got an understanding about what our private lending program looks like. We've got an understanding about the options that you have to invest, either direct lending or the mortgage fund, and you've got an understanding about who our borrower profiles are. Now it's like, what is this marketplace? Again, this is a multiple listing service, but it's for loans. This is the list view. And this is a public marketplace. It's right on our website. And I'm sure a lot of you have already seen it, or you're headed to the website now to check it out. It's under invest and then mortgages. And this is, where everybody shops for their deals. This is where 100% of those 30 or 60 loans per month that we're originating are housed. This is where all of the historical data on Marshall Reddick's private lending program exists for the public to see. Then, on that list view there, you saw that there's a full details button. So I'm showing now, if you were to click into the full details, each mortgage has its own listing page where it's going to break it down in all these sub panels and tell you all of the details that we think you as the capital partner need to know and to be educated on the deal to decide, hey, is this a loan that I want to fund, that I want to become the bank on, that is a good investment for me and my risk tolerance and my yield desire. So in this particular example, this was a purchase loan. It was a bridge. It was a refinance. You can see it's $130,000. So if you're going to fund this directly, you need all 130. You can see all the different metrics, including loan to values, the comps that are selected by the investment analyst on my team that support the values, the scope of work if there's renovation. I mean, it's very exhausting on each listing page for every loan that becomes approved by Marshall Reddick and internal guidelines and becomes available for investment. So as I mentioned, this is like the MLS, but it's for loans, not properties. This is proprietary. We just built this on our website. This is public. It contains our entire loan history. It's live. It's being updated constantly by the team. 24/7, 365. New loans are coming available. Loans previously funded are paying off, so on and so on. Right, this little screen clip here just goes to show you what some of the search criteria, specifically loan status, is and how many loans are in each of those loan statuses. And again, that's changing regularly. But this is where you find deal flow. This is where, I've got thousands of direct lending trust deed clients that have lent money with me and the team over the years. And this is where they go to shop. Right, this is where I, as the principal manager in our mortgage fund, go to shop, to fill up the fund's, appetite for loans that it needs for its shareholders. It's competitive, it's fast moving. So my biggest word of advice is, if you want to get involved, you've got to build a relationship. We need to host a call. You need to get to know the people on the team. You need to let us know that you've got capital. We certainly don't expect you to look at the marketplace every morning with your coffee. You're going to get frustrated doing that, because you're going to see that good loans, which I think every loan that we publish is a good loan, gets snapped up. Sometimes in 5 minutes, sometimes in 5 hours, sometimes it takes 5 days, but these are not like sitting on the website forever. This is a very fast moving scenario. And what we need to do is we need to pinpoint deals that fit your profile. So we need to know what your profile as an investor look like. How much capital do you have? What type of yield are you looking for? Is there any geographic locations for the subject property that you don't want to be in? So on and so forth. Okay, let's get into another poll question. Appreciate always getting the crowd participation. So in this scenario, we're going to talk about, and the question is, what is the most important thing when considering a mortgage, trust deed, or note investment? I'm going to go ahead and launch that poll now, and I would love to get everyone to participate on this, just again to kind of understand, see who's listening to what we're talking about here, get some opinions from the crowd, and so on. I'm going to be looking at the questions from the crowd here while you guys are answering that. Thanks again for the participation. Give just a couple more minutes, a couple more seconds, excuse me. Well, again, we've got some smarty pants on the call tonight. I love that. So we're going to go ahead and close the poll. Okay. and I'm going to share the results. So you should see those now on the screen. And so great, y'all nailed it on the head. And I, perhaps it's just the crowd tonight, but a lot of times this doesn't ring true. I have consultations with capital partners that are coming on all the time. And a lot of times what I see them, they're just naturally attracted to high yield. Okay. No one tonight selected that. No one also selected credit, right? Those are what's not important. What is important, and you hit a nail on the head, is loan to value. The lower the loan to value, the lower the risk. The higher the loan to value, the higher the risk. You always have to have some skin in the game. And a close second, again, you figured this out, is the collateral property location. Right? And what is the collateral property? Single family home, multifamily, is it raw land, whatever the situation may be, right? But you have to be okay owning it. So I'm glad you guys are on the right track there. Don't be blinded by yield. Again, every loan you'll see on our marketplace has been approved and it fits our guidelines. So we take a lot of that risk element out of the situation for you as the oncoming capital partner, but just be conservative, right? And as you're going to see, I'm going to show our track record. We have such a low default, but that's chalked up to good quality borrowers, conservative underwriting, good loan to values, and good underlying collateral properties. Okay. So how do we get involved? Very important. You got to visit the website. Create an account if you haven't already. This is very simple to do. We're not asking for a lot of information, and you've got to explore. You've got to learn how to use this marketplace, right? We can do that together one-on-one on a screen share. You can do that with any of my staff. You can do it on your own, or we've got online resources, other webinars similar to this, where all we've done is focus on navigating the marketplace. As I mentioned there, you got to learn how to figure it out, right? The marketplace is very easy to understand. It just takes a little bit of time to kind of click around and figure out the details. You've got to learn about Marshall Reddick Mortgage Fund because you've got to make an educated decision on which one you like better, direct lending or the mortgage fund or both. I would encourage you to read reviews, schedule a consultation. That can be with me or it can be with one of our real estate advisors. Right? Get to know the team. You've got to like who you're working with because we need to work together so that you know that we've got your back and we know that you've got our back. Build a relationship. It's extremely important. The QR code that I've got on the screen right now, that will direct you to right where you can schedule an online consultation. Somebody will call you immediately. We'll set it up at a mutually beneficial time. Like as I mentioned, you've got to decide between direct lending or the mortgage fund or both. We don't, discriminate against either one. The direct lenders fill a very valuable role in our private lending department, and about half of the money, about half of the 110 million that we lend is housed there with the direct lenders. But direct lenders all have their own capital stack, right? Each individual person's got only so much money that they can allocate to this type of investment in their portfolio. Whereas there's tons of really good, really solid loans that are above whatever your capital stack may be. So we need the mortgage fund to do some of those bigger deals, some of those longer term deals, some of those maybe deals that the direct lenders can't do. And so the mortgage fund represents the other half of that 110 million. And I got a lot of clients that do both. Right, to give you an example, like if you got a self-directed retirement account and you got a couple $100,000 in there that you want to allocate here to private lending with Marshall Reddick, what you might do is end up doing like 1 or 2 loans and then have this like nagging $25,000, $35,000, $50,000 left over on that capital that's just too low of a dollar amount to put into another direct loan. Go ahead and drop that in the mortgage fund, right? That'll help you round out that allocation of capital that you can set aside to balance out your portfolio with some first trust deeds, with some mortgage investments offered by Marshall Reddick. Then ultimately, what do you got to do? You got to execute and make an investment. I'm telling you, you'll be glad you did. I've had so many clients over the years who have just said, you know what, this is just an absolute game changer for my portfolio. I love rental property, I love stocks, I love bonds, I love mutual funds, I love these all other things. But at the end of the day, I've got the collateral of residential real estate in first lien, and I don't have to do anything. I literally just collect a check every month or every quarter if you're in the mortgage fund for doing nothing. And personally, as an investor, that's what I love too. All right, let's talk a little bit about our track record. Very important. Obviously, you want to know that this isn't our first rodeo, right? We're not a huge behemoth of a company either, right? We're not publicly traded. We're privately owned. We always have been. We always will be. So to date, we've originated more than 3,000 loans. Okay, that's a part of the 30 to 60 loans per month that we're originating today, and that amount continues to grow as more people learn about our program and find that it's a really good fit for them. Today we have that 595 active loans in the pipeline. 572 of those are originations, and as I mentioned, periodically there's a need to sell, and so 23 loans still in the pipeline that are secondary market or not the first lender who was the originating lender on that loan. 2,642 loans paid in full, just full payments, full interest, loan paid off, like exactly what you would expect and what you would want when working with Marshall Reddick as a capital partner. And then of course, there are some elements of default, right? That's a part of lending money. There's always some weird scenario that happens, but it's happened 58 times. So when we kind of dial that out, we're talking less than 2%. And I've got my formula for how I calculated that default rate. Again, I chalk this up to really quality, regular recurring borrowers. I chalk this up to very conservative, skilled underwriting. I chalk this up to understanding that, you know, you have to be okay owning the collateral property, right? So we throw out loans all the time. I don't want to own that. It doesn't matter if they're willing to pay 20% interest. It just doesn't matter. Okay, keep in mind too that a default doesn't equal loss of principal, right? So yeah, we have 58 defaults. Does that mean that all 58 people lost 100% of the money they invested? Absolutely not. And in fact, zero of the people of those 58 lost 100%. It's just not possible when you have a piece of real estate that is the first lien security, the collateral for that loan. And so what you'll find is that in most cases, even when you have a default, you get paid in full. It's just uncomfortable because the borrower maybe was delinquent and stopped making the payments, or they didn't make their property tax payments, or they didn't cover the insurance and we had to do something. We had to get a lawyer involved. So out of these 58 defaults, 16 of them ended with a settlement with profit. So that's the lender saying, yes, I agree to let the property sell. I get 100% of my principal back and I got some of my interest. Maybe I had to give up a little bit of my interest, but I got 100% of my principal back. 7 of the time, it was again lender approved. The lender always approves in a default situation, right? These are short sales, right? So the property was able to be sold. The lender didn't have to take the property, and the lender agreed to take a loss. Right, when we're talking about loss, we're talking about 5 or 10% on the principal, and in many cases, not even that much. That's a maximum. So losses are very, very minor. 20 of the 58 actually was a deed in lieu. So the borrower said, hey, I'm upside down. I don't know what to do with this. I'm out of money. I'm willing to, give you, Mr. Lender, the property in lieu of making you go through the foreclosure process. And so a lot of Marshall Reddick clients by trade or initially, we are rental property owners. So sure, remember, I was okay owning that property for the amount I'm lending against it. So I'd absolutely love to take that property. Some of them kept it as a rental property. Some of them liquidated and sold it immediately. Some kept it for a couple of years as a rental and then sold it. Some fixed up the property that the renovation hadn't been complete and sold it for a profit. There's a million different scenarios there. Rounding these out, 6 were a foreclosure sale. Okay, so the culminating effect of the foreclosure process is always an auction style sale that's called a trustee or a sheriff sale, depending on whether it's a trustee or a mortgage state. But at the end of the day, at a foreclosure auction, if the property sells, guess what? You get paid. You set the opening minimum bid, can't be more than you're owed, but you set the opening minimum bid, the acceptable amount you're willing to take to let that property sell. So in those 6, great, you got paid. Again, it was uncomfortable. We had to get an attorney. We had to go through the foreclosure process. But again, our underwriting was solid, right? And there was the lender getting their money back. And then again, lastly, is REO, right? This is a failed trustee or sheriff sale, meaning there was nobody there at the courthouse steps to bid on your on the collateral property that you were foreclosing against. So in that case, right, and this is a scenario where the borrower wouldn't give you the property voluntarily, like a deed in lieu. In this case, you now legally own the property. It is yours. The loan is over, and now that property is yours to do with it whatever you please. Okay, that could mean selling it as is, liquidating. That could mean fixing it up and selling it for a profit. That means keeping it as a rental property. There are, again, many different scenarios and unique situations. So my point in kind of diving through that is just because we have a default less than 2% of the time doesn't mean that you're going to lose principal. It's not catastrophic. It just means we have to take action. And me, my team, my resources, the entire Marshall Reddick organization is here to help if you are to get in a situation like that. We only lend in markets where we have a footprint, right? Meaning we know brokers, property managers, contractors, lawyers, all the people that we need to secure the property to protect the lender's interest in that property. I'll also point you to this URL. We'll be sending out the slides and the recording of this presentation to everybody who attended and who didn't attend. And you'll be able to find this educational piece on our website. And this is something I wrote that defines all of the loan statuses, including those statuses of default that I just showed. And this is really helpful to the education of folks trying to decide that private lending with Marshall Reddick is an excellent investment option for them. Okay, let's get into our second to last poll question. Get that launched for you. This question is, what is desirable about mortgage, trust deed, or note investing with Marshall Reddick? Again, really appreciate everyone taking just a quick minute. I'm gonna go ahead and get that poll launched now. And you can let me know as I'm gonna look again at some questions here to see if we've got any from the crowd that we need to address. Give a couple more seconds there as we're winding up this poll. We've just got one more. This is our 4th of 5. And while we're doing that, I do have a couple of questions that I'm going to address from the crowd, but we'll close this poll first. So I'm just going to give another couple seconds. Okay, we'll go ahead and close that poll now, and we will share the results. Okay. So I love it. We got the majority saying all of the above. Absolutely, right? These are all very key, very important, very desirable items about investing in private lending, right? It's very safe. It offers low risk, and especially for the yield, right? It's very predictable. It's very consistent. There's few variables, if any, right? There's an interest rate, there's a defined loan term, there's defined monthly payments, and so on. It's high yield, right? It's straight cash flow. Of course, you've got Marshall Reddick and our track record and our program, our guidelines, all of this, Marshall Reddick's 45-year history as a real estate professional coming to the table, and you need to work with a good team. And then I really appreciate the crowd participation. I'll go ahead and hide that poll now. Thanks again. And I'm going to take a second and I'm going to ask or answer a couple of questions we had from the crowd. Okay, so one of them asks about the historical returns for the fund. Okay, so we do have a due diligence website that's set up. You can find that right on our website, and that will show the historical returns, right? We have an 8.61% average annual return on investment. So that's the managed fund. That's Marshall Reddick Mortgage Fund. So again, 8.61 average annual since inception. And then the next question, same client, and they're asking about independent third-party bodies that audit the mortgage fund. So we're a small fund, right? We've got about 55 million assets under management. We're a Regulation D 506C, so we do have to register with the Securities and Exchange Commission, but we're not a publicly traded company, and currently we do not have CPA third-party audited financials. That is on the roadmap. We will be doing that. We'll be doing that along with our installation of a sub-REIT, a real estate investment trust that's going to be very valuable in terms of tax benefits. That's going to be coming online. But what I can tell you is that on that due diligence website that I just mentioned, we publish every quarter, right? How much capital we have, how many loans we funded, how many capital partners are a part of that, what the quarterly distribution was. And we also give you the profit and loss statement and the balance sheet. Every quarter, it's there. So I encourage you to go to that due diligence page and you can check it out. Again, this is very transparent. We also show you there what loans are in the pipeline. What's the loan to value? What's the makeup of the collateral asset? I mean, I don't know any other fund out there that's doing that. If you guys do, please send me an email, share with me. I'd love to know because I'm always looking to find other good investments as well. Okay, let's move on. Okay, so interest rates, right? Very interesting. I didn't realize at the time when we scheduled this online educational session that was going to be the last Fed meeting. So I'm sure we all know who this is, right? It's basically a celebrity today, Jerome Powell. And if I understand correctly, they held rates today, right? They decided not to hike again. And I think they actually even alluded that potentially there will be some rate cuts in 2024. What a shocker going into an election year. We'll see what comes from that. But nonetheless, here we are to our fifth and final poll question. I'm going to go ahead and get that because I love the sentiment from the crowd. And this is meant to be a little bit funny too. So the question is going to be, where is the conventional mortgage rate headed? I'm going to go ahead and launch that now. I'll continue to read through some of the audience questions here as we're winding up. I hope to be able to answer any others that are important. Give a couple more seconds there. Thanks everybody for your participation. Okay, I'm gonna go ahead and close the poll. Okay, and we will share those results. So I'm surprised. I was expecting to see some folks in double digits. You know, I certainly hope we don't see that. I think a lot depends on who gets in office in 2024, but I'm telling you, I won't be shocked if we see double-digit interest rates, right? That's on the conventional side. I think a majority of the sentiment there is going to be that, 7% is here to stay. I definitely would agree with that. Those that are thinking, can't wait to see 3% again, I just don't see it. We were just so low for so long. I hope you locked in your 3% 30-year fixed on your primary or your investment properties before these massive rate hikes, but I don't see us seeing 3% again, just not happening. If you don't have a clue, I can see that too, right? Who knows these days? It's like nothing in the world surprises me, right? But at the end of the day, what I do realize, I'm 42 years old now, worked for Marshall Reddick for 20 years, is just that, again, nothing surprises me anymore, and that business continues to come. Technology expands, and that's going to continue to happen, and people, especially real estate people, find a way to make money. Okay, so I'm going to go ahead and hide that poll. Thanks again for the participation. And before we move on and wrap up here, I'm going to address another couple questions from the crowd. One of them, this seems like more from a borrower's perspective. It's asking about private money resources that can be used for down payment on, say, a fix and flip, or can you, Marshall Reddick, as the lender, fund 100% of purchase and renovation? Unfortunately not. Certainly we do not promote that type of loan to value. As we've discussed, there are always borrower skin in the game. We will fund 100% of renovation, but we will never fund 100% of acquisition, right? It's just, that's a foolish way to do things, right? If you don't have the money, you just need to save for the money, or you need to, find some other ways to come up with it. We also don't allow any junior lenders. A lot of borrowers out there say, sure, I like your term, but I'm going to go use this gap funder. I'm going to use this second lien lender I'm going to pay them 20% and they're going to bring me the down payment. We don't allow that, right? Strictly first lien, and it's written in your loan documents that if you take out a second, we reserve the right to foreclose. Another question here before we head on is going to be, and this is a very good one. Okay, so let's talk direct lending, right? So you're a trust deed investor and you want to fund loans for us. How does that set up, and how does Marshall Reddick make money? Okay, we are the broker, we are the arranger, we are the originator, right? And we're lending your money as the capital partner. You as the capital partner earn 100% of the interest paid by the borrower, and we, Marshall Reddick, earn 100% of the loan fees or the origination fees paid by the borrower. Again, you earn the interest, we earn the fees, right? Periodically, there are some lender credits that are offered, or some lender rebates where we will share a piece of the origination fee with the lender, but generally those happen on the 24 to 60 month loan terms, not on the 12-month or less loan terms. The yields are just too favorable and there's too much work in this. We're obviously in business to make money, as any business would be. Okay. The other question, same client there, is about prepayment penalties. Absolutely, right? We dislike the wholesaler who takes out our loan and pays it off within 7 days. So yes, on all loans that we make, except for our bridge loans, there is an interest guarantee. Our fix and flip loans, our short-term debt, it's generally a 3-month interest guarantee. So the borrower is certainly welcome to pay you off in any period of time they want. They can pay off in 1 day, same day if you'd like. You as the capital partner are guaranteed at least that 3 months worth of interest. Our longer term loans, those oftentimes have a 24-month, a 2-year interest guarantee. And we see a lot of folks, a lot of borrowers pay those off early. And hey, kudos to you as the capital partner. If you earn a huge rip that translates into like a 20-30% yield because you gained that prepayment penalty, yes, that you as the direct lender, any prepayment penalty is 100% yours. We do not take a piece of that. Okie doke. Great session. Appreciate everybody. We're going to wind up here. I've got my contact information on the screen. That's my cell. You're welcome to call, text anytime. You can send me an email. I'd love to schedule one-on-ones with you. I will be following up via telephone just to kind of understand what your thoughts, get your feedback. And again, the number one takeaway before I get to the couple final questions is that you got to give this a try. Whether you've done it with somebody else or you've never done it before, make an educated decision to say, you know what, I'm going to try that. I know you're going to like the program. I know you're going to like the level of customer service that we provide, and you're going to be stoked that you entered into this other investment option that Marshall Reddick offers. Okay, so that said, I am going to answer just a couple of last questions before we wrap up and send everybody on their way. Okay, when it comes to the income and tax, I'm not a CPA, not giving you tax advice, but as a direct lender, remember I said you're earning the interest paid by the borrower. So as a direct lender, if there is tax documentation, you're getting a 1099, right? And I say if because sometimes there's not a third-party loan servicer, it's the borrower paying you directly, and sometimes the borrower doesn't issue a 1099. Marshall Reddick is not the servicer. We're not collecting payments and remitting them to you in the direct lending program. So the nature of the income is interest income. Now, pivoting and going over to the fund, right? It's a California partnership, right? Currently, it's going to become a real estate investment trust, likely at the end of 2024, could be early 2025, but it's roughly 10 to 16 months from now. But currently we're a partnership, so we're issuing a K1. When we pivot and we install that sub-REIT, we will be issuing a 1099 dividend or 1099 DIV. Okay. Looking through the rest of this. think that'll do it. Yeah. Appreciate everyone's time. Thanks again for joining me. Again, my name is Patrick Prunty. I appreciate you. A very happy holidays, a very happy new year, and I look forward to welcoming all of you who are not current clients on as new clients in the coming days, months, and year. So take care and appreciate everyone again. Bye-bye now.